Graham, if you can give us a 60 to 90-second breakdown of you, please.
Sure. And thanks so much for having me on, Alex. I'm excited to be here. So I'm Graham Bachman, Managing Director and Head of Business Development at Hidden River Strategic Capital. We're based here in Radnor, Pennsylvania, which is in the suburbs of Philadelphia. I joined the team here as we were doing our first close on our current and first fund back at the end of 2022. Before that, I spent some time at a large alternative investment fund manager, and then on the direct lending team at a large single family office, both here in town. Over time in my career, I've found myself gravitating more toward the lower middle market. It's a more fragmented and less institutionalized space, which creates unique opportunities for flexible capital solutions. At Hidden River, we really focus on providing creative structured capital. So kind of custom blends of debt and non-control equity to founder and management owned companies that tend to be in the $2 to $15 million EBITDA range and set across a wide set of industries. It's it's a space where creativity and relationships really matter, and where we believe the lack of kind of an efficient capital market creates real opportunity, and that's what drew me here. It's it's been a really great first 2.5, almost 3 years. A thrill to have joined on the ground floor at the beginning of a firm and beginning of a fund. We're now fully staffed up and about halfway invested in Fund One, which ended up right around $250 million in size.
Perfect. What's one mistake that you see either private equity firms or portfolio companies making, and what would you suggest to correct?
Yeah, I don't know if a mistake is the word I would use that other funds are making, but more so a gap in the funding landscape, particularly in the lower middle market. Most private equity and credit capital is designed around M&A, the buying and selling majority stakes and leveraging up those deals. But not every founder wants to sell or take on a rigid debt structure. There's a whole universe of business owners who are looking for capital to grow, recapitalize, or take some liquidity without giving up control. And yet, there's no clear, well-defined path for them to find flexible options. And that's where structured capital comes in. It kind of fills the white space between traditional debt and equity, offering kind of a more tailored solution for businesses that don't fit the standard private equity mold. So the opportunity that we see and the reason Hidden River exists is to serve that unmet need. We're really focused on helping founders access capital that's aligned with their goals, not someone else's ownership timeline.
So talk to us more about kind of how that works, what that structure looks like. And you mentioned obviously the kind of someone else's timeline. Are you guys there for long haul? Just kind of give us a better picture of what this structured capital means and looks like.
Yeah, someone else's timeline, more referring to the business owners being able to retain control. We are kind of a traditional 5 to 7 year target hold period ourselves, but the securities we invest makes it such that they don't have to sell their company at the end of that time frame necessarily. But to dive in more on the definition of structured capital, it's capital that contains structured features such as a fixed return, a maturity date, a mechanism for liquidation, et cetera, as compared to unstructured capital being just plain common stock or common equity. Structured capital came into being as a term probably around 2010 or so, early 2010s, when some credit firms started investing meaningful amounts of preferred equity alongside their debt investments. So the term was coined as a way to wrap the whole strategy sort of under one label. I would think of it as the overlap between traditional buyout equity on one side and mezzanine debt or cash flow lending on the other. And we try to operate in that middle zone, providing the best of both worlds. That allows us to support management-owned companies across a variety of situations, whether they're trying to fund organic growth, fund add-on acquisitions, or shareholder recapitalizations like partner buyouts or dividend recaps. So often we're stepping in as a partner to these businesses when a pure debt solution is overly restrictive or unavailable because maybe there's a lack of collateral or cash flow on one hand, and then on the other, where traditional equity might be too dilutive or require giving up control. So by combining debt instruments with less dilutive preferred equity, we can structure a solution that protects our downside while maximizing the upside for the existing owners. So we try to flex up and down the capital structure. Will range from senior debt to significant minority equity ownership. And in doing so, we try to give founders the flexibility they need to execute on their plans without giving up control of the business that they've built.
So if we think about that from a low middle market businesses, founder-led, founder-owned, are you typically retaining the founder in the business and then beginning what regard as the atypical private equity professionalization?
Can you repeat that question?
Sorry, are you typically retaining like the founder in the business as the chief exec and then supporting them on the journey of kind of private equity backed professionalization of that company?
Yes. Yeah, I think our preference is to back the existing management team at a business. So oftentimes it's the current owner or current CEO are one and the same, and they have gotten this business to a great place where it is today. They're a manager that we can diligence and back and be comfortable with, and they just need some sort of structured capital, flexible capital solution to achieve the growth or the transaction dynamic they're looking for. Sometimes we'll engage with management buyouts as well, maybe a management team that owns a minority stake in a founder-owned business, and the founder or the family is ready to sell, and we can support the existing ownership team or the existing management team become the majority ownership in that business. But it's really about trying to back the existing management group, the existing ownership group with sort of flexible capital. We're not going in, taking majority control position, putting in our own CEO and ripping out the C-suite like some private equity funds do.
How does that? I assume there's obviously a traction on that. I assume that limits the kind of investment. If we look at a lot of the firms that we support in executive search, low middle market businesses, they'll do a roll-up type of deals. They'll do a investment in a business to take it on organic growth strategy, and 9 times out of 10, probably 19 times out of 20, probably going up. The chief exec's not quite at the level that they need to be at. So no doubt, selective nature of your investments. But how hands-on are you with regards to that professionalization work, being a minority holder? Well, let's go with that. How hands-on are you guys with the minority holdership in the professionalization of the business and growth of the business, should we say?
Yeah, if the question is around how involved are we operationally in the business, I would say it's limited. and it's kind of a selling point for us. We spend a lot of time not only underwriting and understanding the business itself, but also ensuring that we can trust and support the existing management team. They've built a great business to date, but they need a little extra gasoline and they want to stay in control. They want to double down on their business. So we'll help professionalize. We take board seats and we are in constant communication and building a great relationship directly with the ownership of the business. And we'll help prepare potentially for a larger exit in the future. Whether it's helping to build out the C-suite or the finance function, or work with other intermediaries to understand what would help increase value of the business in the long run. But the day-to-day operations and management of the business, we are entrusting that the CEOs and the management teams we back are going to continue to do a good job, and we're there to support them.
Does that come with where do those guys go to get that kind of development? Do you offer that internally, or is that that's not our structure, that's not what we do? If they do need help in scaling and becoming that kind of trusted advisor within the portfolio?
No, we're absolutely there to support them and help them if they would like, or if they need the help for growth. I think what a lot of private equity firms pitch is that they're going to come in and take your business to the next level because they're so smart in XYZ industry. We take kind of the opposite side of that coin. We think that there's plenty of very capable managers and CEOs that own businesses today that are more than capable of growing their company if they had a flexible capital partner who can be a sounding board for them. We can provide our thoughts and some level of expertise, especially on the finance function, obviously. But we don't go into a situation with a business or a process and say, hey, you need to work with Hidden River because we're the best in XYZ industry. We're going to take you to the next level. You're going to have to listen to what we have to say. It's the opposite. It's, hey, we think that you've built a great business and you're in market today because you need capital to achieve X, Y, and Z. We can provide you that capital. We can support you. You can maintain control. And I think that resonates really well with business owners.
Perfect. So you obviously focus on the deal origination. Tell us about what you're doing on that side to differentiate yourself as innovative to generate new deals into the firm.
Yeah. And one of the most consistent reactions I get from business owners is surprise and excitement, frankly, that private equity firm like ours does not require that control ownership. There are a lot of motivated owner operators out there who do want to double down and grow and not cash out, not give up control. But as we talked about a little bit, most of the capital in the lower middle market is geared toward full buyouts. So the challenge on sourcing is that the ecosystem isn't really built for structured capital. Most intermediaries, whether it's investment banks, lenders, other GPs, are set up to transact in majority control M&A. So there's no well-defined network helping owners find flexible minority capital solutions like ours. So that creates both a sourcing challenge, but also a huge opportunity. So a big part of our differentiation is really education and consistency. We spend a lot of time helping intermediaries and other GPs understand how we're different from traditional buyout or credit shops. We're not doing cookie cutter outreach or chasing industry theses. We're very relationship driven. We try to be creative and consistent with how we show up in the ecosystem. Um, Sometimes it can feel like we're trying to boil the ocean at times, but by building trust with the right centers of influence and being top of mind when a flexible capital need arises, we're carving out a space that most other funds just don't play in.
So interesting. So what do you read? What do you watch? What do you listen to, Graham, that you should recommend that others check out?
Well, obviously, everyone should be listening to the private equity podcast. But beyond that, I keep up with the usual suspects, the Wall Street Journal or other industry publications. I never miss a Howard Marks memo. He just released a really interesting one about government intervention, which is timely. On the book side, I have a few go-to classics, whether it's Good to Great or How to Win Friends. One that not everyone knows is The Colossal Failure of Common Sense, which is sort of an inside look at the Lehman Brothers collapse. But one book that I always recommend because it really stuck with me is Thinking in Bets by Annie Duke. It is not an investing or finance book per se, but it's incredibly relevant. It's about improving decision making when you don't have perfect information, which is basically what we do every day in investing. It helped me think more probabilistically and also to separate outcomes from the decision quality, which is crucial in postmortems and strategy conversations.
And if anybody wishes to reach out to you post this podcast, how best do they get in touch with you, please?
Yeah, I'd love to speak with anyone if they like to reach out. My email is gbachman@hiddenrivercap.com. And every one of our contact information is listed on our website as well, hiddenrivercap.com. You can find our information there.
Excellent. Well, thank you very much for coming on the podcast, Graham. I know you're a listener, so thank you very much for being a listener as well. If you can stand listening to your own voice, unlike me, you'll be able to listen to your own self on it. But really appreciate you coming on, sharing us with your deal origination strategies and what you guys are doing to differentiate, but also diving into your terms structured capital and how you're leveraging that with being a minority investor and servicing an area of the market which maybe private equity misses because of its ownership and kind of accountability. Well, maybe not accountability. Its ownership structure of really taking, or its control structure, probably the right thing. So thank you very much for coming on the podcast.
Thanks for having me, Alex. It was a pleasure.
And as always, thank you very much for all our listeners tuning in yet again to the Private Equity Podcast. Till the next time, keep smashing it, and thank you very much for listening.